Hey, how's it going? It's about 15 minutes after the closing bell on Monday, January 13th, and the last time that we talked about how the S&P 500 was really in this very large chopping range. So since the gap up over here, since the election, yes, we traded higher, but then we traded all the way back down and now we're even lower. So we are in this choppy range back and forth. Now, it does look a little tenuous on the surface, so we want to examine this very carefully. What we've had here was a high, then a lower high, then a lower high, although it's pretty close to equal, it is a lower high, and so we have a series of lower highs. We had this low over here, a lower low, an equal low, and now a lower low. So this is developing into a downtrend. Now, I wouldn't say that we are headed down just yet. This is still in this big, large, choppy range that we defined and that we were talking about before. However, if we keep breaking down, then we will find ourselves in a more bearish situation. So we are looking at being on the cusp of being in a bear market, or at least a short-term bear market. So let me draw this real fast. You can see if I draw that rectangle right there, we are just with that low, just barely kind of scrape the bottom of this where we look at this gap fill. And if I want to be a little bit more generous, I could bring that down all the way down to here, but for now, I'm just going to do this. So we can take a look that if we bounce from here back into the box, then we're just back to choppiness, back to sideways choppiness. But this does look like it can be forming a downward trend, and that we may be entering into a bearish phase of the market, or at the very least an early 2025 correction, which I talked about the distinct possibility of in the previous two videos. So let's take a look. Which one? Are we going to chop sideways, or are we going to move lower? Like, which one is the more likely scenario? For sure, we're not super bullish at this point in time. So let's take a look at market internals. Let's take a look at momentum levels. Let's see what we can find out. So first thing that we want to see is, after we've noted this downtrend and this potential breach downwards, well, we do have a little bit of support. Let's draw our horizontal support lines. So those are our areas of liquidity, and that would be one right there, and there would be one right here, pretty much exactly where we are. So I wouldn't necessarily be comfortable calling this like a bearish leg to the market until we went below this level right here. So these lows, which are similar to these highs right here, but we are definitely on the cusp and threatening. So do we bounce from here? Since this is an area of liquidity, does today's green bar constitute a bounce? Or do we have more to fall before this could bounce upwards? Or do we continue to stay bearish? So let's take a look first of all at the RSP, the equal weighted SPY. I want to see how the Mag 7s, or the top highly weighted stocks, are affecting the S&P 500. So let's take a look at RSP. But first snapshot, we saw that we are a series of lower highs, a series of lower lows. We are below the EMA 100 at this point. Looks like we might have retraced back up to it. It's really hard for me to see. I need to change that color so I can actually read those numbers on this computer. Where are my settings? I don't see. There we go. Okay, let's make you this kind of burgundy color for now. Looks like we're at 583.17 for that EMA 100, and we are below the EMA 100 still. So that is resistance. The EMA 8 to our, what is this? The EMA, 8, the EMA 20, and the MA 50. Those are all resistance. So we have to be very careful here, because even if we bounce, if we hit any of resistance at any of those levels, that's going to be yet another lower high. And we could be seeing this develop into a downtrend. But we just need to see a break of these levels right here, this roughly just call it 570. If we break 570, then it's looking more like a downtrend than it is a chop sideways inside of that box that we drew earlier. So what we want to see now is compare that to the RSP, the equal weighted SPY. So when I look at the RSP, you can see that RSP is in much deeper doo-doo, much worse shape, but we did come down and get near that MA200. So if that acts as strong support, we do have horizontal support here as well. So that could act as strong support. RSP bounces from here, is able to stay upwards, and then we get a rebalancing, some money coming out of the mags and into the rest of the market, then that's actually a healthy sign. That's pretty good. So if RSP can bounce from here and maintain this strength, then we could see some rebalancing in the markets, and that would make for a nice setup for us to continue a bullish run in 2025. But what we want to see is that nice clear movement, nice clear bounce that does translate into S&P 500. So it would probably take a little bit of time to rebalance. So if that was the case, we're probably looking at these lower levels in this S&P 500 for a little bit, meaning that we could consolidate here before moving upwards. So even though that is good news and that support, it doesn't mean that we're going to move up from here in the S&P. Let's take a look at the same thing in the QQQ. QQQ, we've got a gap down, or not a gap down, sorry, a pull back to the EMA 100 and then a bounce off of that. So that's kind of good news for QQQ. That's definitely stronger than the S&P 500. And let's look at QQQE. Equal weighted QQQ came and bounced off of the MA200 once again, similar to the RSP, and it is just above the MA200. So if that can hold, then we can continue to consolidate sideways in the overall markets, in the SPY and the QQQ. So let's take a look at IWM. IWM looking very much like QQQ. So it looks like we're challenging that MA200, and that needs to hold. If we break the MA200 in these small caps, if we break it in the equal weighted indices, the RSP and the QQQE, that is really bad news, because that means the majority of stocks are trading below the MA200. That's more than 50% of stocks trading below the MA200, and then by definition we would be in a bear market. So we'll take a look at those numbers a little bit more closely in just a moment, but right now it's a decision point. We're at a decision point in the market, so we're going to want to watch these markets very carefully. We're going to want to be very careful about putting on any positions right now. If we do, they're going to be in small size, or they should be some sort of spread, buy something, sell something, give yourself some protection, or small allocations if you want to do a directional trade. This is a decision point inflection in the market, and you either want to be in cash or you want to use a small position to kind of capture a potential move, assuming that you get that move right. So basically, either we're going to move downwards fairly and be in a bear market, or we're going to bounce and stay in this large choppy range consolidation that we've been seeing in the S&P 500. I don't think we're going to see all-time highs anytime soon here. It's, at least right now, it doesn't look like it's going to happen in January, and not too optimistic about it happening in the first half of February either. So that would have to be quite a bounce in order for us to get back to these all-time highs. So not to say that we can't, but we have to get to those all-time highs and then break it. Now, we do have inauguration coming. So in exactly 1 week, President Trump is going to be inaugurated as president once again, and we could get some stimulus from that. And if he announces any new policies that are going to be put in place, if Congress passes anything between now and then or shortly thereafter, then the story changes. It constitutes a fundamental change or a fundamental shift in the markets. So we would have to reevaluate at that point in time, waiting for right after inauguration. But until then, this is what we have. This is what it looks like. We also have, I don't get too far ahead of myself. So we looked at the IWM. Let's take a look at the Dow Jones. Dow Jones is looking very similar to the S&P 500, very, very similar to S&P 500. So same analysis, same commentary there. So all of these major indices are at a decision point, and we just need to see how the next few days go. It may be that we don't actually pick a direction until we get to inauguration. We might just see some chop. So right now, like I was saying earlier, it is a low probability environment for directional trades, and so you're going to see a slowdown in the trades that are directional. So for my services, that's the Gamma Pocket service. I know a lot of the other people who are at the trading pub, they're not issuing as many trades because we're all seeing this choppiness and this froth inside of the markets. It's going to be very difficult, if not impossible, to make money in any sort of directional trade that is longer than a day. Day trades are still okay, but anything longer, you're going to have a lot of difficulty with that. So let's keep that in mind. The other thing that we want to see is economic data that is coming up, because without any big economic data, then it really is just going to be that inauguration. And I guess I don't have it open, Econo Day. Let's get that open real fast, and then we can check on some momentum levels, and then we can take a look at some 90-day highs in those. So if we go to us.econoday.com, what we'll find is that we had PPI coming out, we have CPI coming out. We're not expecting better numbers there. In fact, if you look at the consensus around those numbers is actually higher than it was a year ago. So we're expecting higher prices than a year ago. That is the definition of inflation. So let's take a look right here. Tomorrow, Tuesday, we have PPI. PPI a year ago is 3%, now consensus is 3.3%. That's higher prices for producers. That is inflation. And then we've got CPI. We got 2.7 was a year ago, and then consensus is 2.9. So we are expecting inflation. We are expecting higher prices. Once the market gets wind of that and decides that, hey, maybe the Fed isn't going to cut rates at all in 2025, or maybe we're actually going to increase rates, then what's going to happen in the TLT, and probably I wouldn't be surprised if it actually started to be priced in, is that this is going to continue to drop. And that is going to put a lot of pressure on the speculative stocks, on the IWM, the small cap stocks, on the large cap tech stocks. A lot of those are going to be under pressure to compete for yield from the US Treasuries. So that is going to limit the market's ability to continue moving upwards. Let's take a look at the FedWatch tool and see how that's being priced into the markets. But while we wait for that to load up, I'm going to take a quick look at my momentum. So if I look at overall market momentum, then we're seeing that the number of stocks at $2 or above their 200-day moving average is already less than 50%. In fact, if I look at all the averages, they're more than 50% below the 5-day, 20-day, 50-day, 100-day, 150-day, 200-day. So the overall market is showing weakness. It is already looking like a bear market. Now let's take a look at our major indices and our sectors. And what we're seeing here, let's just take a quick glance at the 200-day. So we're at the cusp on the S&P 500. On the Russell 2000, we are already below 200. And then on the NASDAQ, we're also at the cusp. So we are in danger. This market is in danger of slipping into a bear market. Now, we're not completely bearish yet, and things could change because of inauguration. But as of right now, we want to exercise a lot of caution. Now, either those CPI and PPI numbers are going to surprise us to the downside, and we're going to get a breakdown in the markets before inauguration happens, or things are going to be somewhat in line or somewhat better than expected, and then we could just see a recovery, a little bit of a bounce in the markets, heading back into this range right over here, this nice choppy, large range choppiness that we talked about in previous videos. So we'll take a quick look at that CME. We are now basically pricing in 100% that we are not going to get any cut whatsoever. And for whatever reason, this market still thinks there's a 2.7% chance of us getting a rate cut in January. I don't think that's going to happen, especially with those PPI and CPI numbers being projected. So 97.3% is already a large enough number that this going down to zero isn't going to have a huge effect on the markets. But let's take a look at March and see what those numbers are. All right, that's taking a while to load. So let's take a quick look at or at least get our sector scan going. Our 90-day highs. Today we've got 38 90-day highs, 142 or 201 90-day lows. So those are middle of the ground numbers, obviously a little bit weighted towards the downside, but nothing too exciting. Again, everything that we've seen so far has more of a bearish lean to it than we do have a positive or a choppy sideways lean. So right now we are looking a little bit more, going to be a little bit more cautious, looking for that market to potentially break downwards. But again, it maybe nothing gets decided until inauguration, and inauguration maybe gives us a little bit of enthusiasm. But so far in 2025, things are off to a shaky start and we're on shaky ground in the markets. There are a lot of forces here that are pointing towards a bear market, as we've just seen. And you can see that there is actually being priced in a, let's see, current is 425, 450. Okay, so no rate cut. So we're still pricing in rate cuts instead of rate hikes. Now, if PPI and CPI change that sentiment and we start pricing in rate hikes in here, that TLT is really going to lose its footing. It's already looking terrible. That's a very strong downtrend that it's in, but we could see potential gap downs and an acceleration downwards if we start to suspect that the Fed is going to start raising rates instead of cutting rates or keeping them where they are. So those are the things that we want to watch for very carefully. For now, it seems pretty likely that we're going to just chop sideways until inauguration. But if anything does happen, if there is a directional move, it's more likely to the downside. And then when we get to inauguration, we'll have to see from there. But technically, everything is looking a little bit weak. The only good things that we saw is that the RSP was bouncing off the MA200, the QQQE was bouncing off its MA200, the IWM bouncing off its MA200. However, a single bar doesn't do it. We need to see continuation and follow through on those bounces. Otherwise, it's just a one-day anomaly and we're either chopping sideways or we could break through that MA200 once again. So in a nutshell, we want to exercise caution. We want to go smaller size if we want to trade directionally, and otherwise we probably should stick to spreads in this current environment, just so you have some protection. Buy something, sell something, protect yourself. Don't get eaten away nearly as much by time decay, things like this. So choose your investments very carefully during this time period and choose whether or not you're going to go directionally very carefully. And if you do, small size, there's no need to be a hero. Just wait a week and we'll see if directionality comes into the markets after inauguration. So you don't lose anything by waiting. Cash is a position, is a valid position and a defendable position. No fund in the world will blame a portfolio manager to be in cash during a risky environment. And right now we are in a risky environment. Okay, so that's it for today, folks. Let me know if you have any questions. You can always email me, kane@investpub.com, and I'll see you in the next one.